Hi, I'm James Robinson. I manage money for a living. My company is Robinson Stocks, and this is my stock pick of the week. This is my fifth and final video on the company Lazyboy. Today we're going to be looking at wealth creation. What I mean by wealth creation is the management doing things which are likely to make the shareholder richer. By that I mean, are they paying dividends? Are they buying back stock? What are they doing with retained earnings? All of the things that a company does with their profits that either can make us wealthier or not make us wealthier. So that's what we're really looking at today. So the first thing that I look at with wealth creation is shares outstanding and the amount of stock repurchased. What I'm looking at here is the company makes a certain amount of money every year, and is that money being used to buy back stock? We've talked ad nauseum in other videos about why we should care if the company's buying back stock. Long story short, as the company buys back stock, I own larger and larger percentages of the company. I get a larger percentage of any dividend dollars the company's willing to pay to shareholders. I get a larger percentage of earnings, and as those earnings increase, the stock price should increase. So the idea that a company would buy back shares is good for us as shareholders. So let's talk about what's happening here. For a long time, this company's shareholdings were pretty static at about 52 million. However, they've been buying back shares really for the last 7 or 8 years. That trend has continued. It's kind of diminished a little bit in the last year or two. I strongly think this company is going to really start buying back shares significantly faster going forward, but we'll see about that. But long story short is, yes, the company is buying back shares. We'll talk more about that in the next slide. So let's put those share repurchases into context. So if you'd bought 10% of Lazyboy at the end of 2010, that would mean you would have bought 5.18 million shares. Today, through stock repurchases, your 5.18 million shares would mean your ownership in the company has gone from 10% to 11.27%, which means you'd own about 12% more of the company than you started with. And you'd have done that without investing any more money. And during that time, you've been paid out all of your dividends. So we basically got an extra free 12% of the company as a result of stock repurchases. It's not a ton of money. It's not a ton of benefit, but it cost us nothing. And as you'll see, it actually paid additional benefits. So your share of the company's earnings would have gone from $2.4 million. So the company made $24 million 10 years ago, and you would be entitled to indirectly 10% of that as 10% owner, to $12 million over the last 10 years. So it would have gone from $24 million in earnings to $120 million in earnings, and your owner's share would have gone from 2.4 million to 12 million. I looked at another way, the earnings per share would have gone from 46 cents a share to $2.32 per share, and that's an increase of 399%. So again, we've been paid significantly to just hold the company and be patient. So that's one of the things that management has done to make us richer, is they've bought back shares over that time. Another thing we look at is stockholders' equity. Stockholders' equity is not a direct measure of stock price, it's not a direct measure of value, but it shows us what's happening with the company. So I look at shareholders' equity both in terms of the equity dollar and in terms of the equity per share. The shareholders' equity has gone from, in 2008, about 300 million to about 800 million today. So that's just under a tripling, say 250% during that period of time. And on a per share basis, it's gone from about $5 a share to just under $18 a share. Again, that's because of stock repurchases. Shareholders' equity is important just because it gives us a sense of the value of the business increasing over time. If we're able to get good returns on equity, that means we're getting more and more profits. Again, equity is total assets of the company minus the company's total debts. And we like to see that going up and to the right, as with most charts. It's not the most important thing in the world, but again, it's the company, as the equity increases, it kind of creates a floor. The value of the company is certainly not going to go below the value of its equity. So the next thing we look at is return on assets. So again, I always look at return on assets as being really important. The argument here is it takes money to make money, but good investments, it takes less money to make money. Or how much money do you make off the money that you've invested? So again, the assets is the total amount of money that the company is kept from the shareholders and utilized in its operations, and what kind of return are we getting? And so when you look at this chart, the red line is the top 10% of all companies, and the green line is the top 25% of all companies. And you can see the return on investment for this company is very, very solid. It's in the top 25% of companies. And so we see this company as being relatively efficient in the money it's holding. It's not spectacular, but it's solid. And so again, we like this in the company. It's a long-term sign that this company is a good investment. And so again, I wouldn't buy this company simply because of its return on assets. I'm really buying this company because I'm getting a very solid return on assets, and I'm buying this company at 6 times earnings. So I'm getting it very, very cheap. The next slide is sort of the same thing as the last slide, only it's return on shareholders' equity. As I talk about all the time, I prefer return on assets to return on equity. My investments are typically going to perform much better when compared to other companies in terms of return on assets than they are return on equity, because I place such a high value on companies having zero or relatively low debt. When you have debt, that means that you have significantly less equity, and the same amount of returns create a higher return on asset, or same amount of profits create a much better return on equity than it does a return on assets. And so my investments tend to perform less well in terms of return on equity, and I'm fine with that. This company is in, it's not in the top 25 or top 50% of companies. It's in the top 50% of companies, but not the top 25% of companies in terms of return on assets. And I'm fine with that. I don't care, because I know this company has no debt, and I'll live with the fact that it's not just knocking it out of the park in terms of return on equity. One thing that is really important to me with a company is retained earnings. So when a company makes profits, there's a number of things they can do with that money. They can pay it out as dividends. That's directly good for me. I get cash. They can pay it out as buying back shares. That's very good for me as well, but less directly so. They can use that money to pay down debt. That has a long-term benefit of the company, that we have less debt, we have less interest expense, we have less exposure to downturns. So I'm okay with that. It's not as good as the first two, but it's still solid. They can simply put the money in cash and save that for future opportunities. I don't love that as much, but it's not the end of the world. So if they don't pay it out in dividends, and they don't pay it back in share repurchases, then they're retaining that cash. And so if they retain cash, I want to see that money that they're retaining, they're using very effectively. I also don't like companies that need to retain a bunch of cash, because every dollar they retain is a dollar they can't pay me back. And if there's a trend there that they're retaining tons and tons of money, then that tells me I'm never going to get my money back from this company. And that's just not very exciting. So with this company, you can see that even though the earnings have gone up gradually year after year after year, the retained earnings have been very, very flat through that period of time, which tells me they're able to earn ever higher returns on the money that they're keeping. And that's something that really excites me as a shareholder. One thing that I like to do is try and get a measure for, if they're retaining cash, how efficiently or effectively are they using that cash? And I don't know if there's any real easy way to do that. I've got a shorthand that I use, which may or may not be accurate, but works for my purposes. What I simply do is say, how much cash did the company retain over a 10-year period of time? And how much did the profits go up over that 10-year period of time? And I'm willing to say that the company can attribute 100% of those extra profits as a result of retained earnings. Now, I realize that that's not accurate. I realize there's a whole bunch of other things that might cause profits to go up or profits to go down. But for my methods of trying to figure out return on retained earnings, I'm just going to assume that. And then I put a relatively low bogey that the company should be earning a 10% return on investment. And if they're able to do that, then I presume the retained earnings aren't a problem. I also think that if I do that over a long period of time, there will be occasional periods where the company kind of fools me. But in the long run, the company's profit should be increasing at greater than 10% based on the amount of money they retain. So you can see with this company, it's been spectacularly high on return on retained earnings. But basically over the last 10 or 12 years, it's been able to retain at least 10% return on retained earnings. That's all I need to see. I'm comfortable this company isn't increasing its retained earnings faster than its profits, and I see that this company seems to be earning a fair return on retained earnings, and that's all I need to see. I have no problem if this management wants to retain earnings. I'll presume that they know what they're doing. One of the things the company can do with their profits is to retain cash. And you can see here's cash and marketable securities for this company. You can see that the company gradually from 2008 was able to build up its reserves from, let's call it 30 or 40 million to something like $150 million. That's great. That's a 400 or 500% return, or 400 or 500% increase. That's wonderful. Then the company was very flat from about 2010 through 2018. That's also good. That means they don't need a lot of additional cash to run their business. They had a nice safe buffer, but they didn't require any more. That was great as well. Since 2018, this company has dramatically increased the cash and gone from about 300 million to about 400, gone from about 150 million to almost 400 million in cash. I don't understand why they're doing that. My hope is that we're going to see some significant increases in dividends. My hope is that we're going to see some significant increases in buybacks and sort of get that number down over the next few years. Failing that, I'd want to see some really fantastic increases in profitability that lets me believe they're using that money efficiently. I'll keep an eye on that over the next couple of years. But this company's been very, very conservative in the way they do things. And so my hope is that they'll continue to do that. But I am keeping an eye on this. I don't think there's any reason, based on what I know right now, that this company needs 400 million in cash. This next slide is the average annual wealth created by the company. So I've talked about that a company can do a number of things with their cash. They can pay down debt, they can pay dividends, they can have stock buybacks, they can increase their cash, and they can retain the money in the business. And what I want to see is over the last 5 years, over a 5-year period, how they've done. So you can see that all of these lines, dividends, stock buybacks and stuff, have sort of been squiggly over those period of 5 years. But what's the total that's happened as a result of that? And you can see that this orange line shows that the company has managed to do very, very well in terms of creating wealth for the shareholders over that long period of time. And that's a wonderful sign. So I'm very comfortable that this management's doing a great job. I want to talk about one other thing with this company because it's the single biggest reason why I think you should buy this company. I think it's a solid company. It's not spectacular, but it's solid. I think they're going to continue to grow their earnings. Again, not spectacularly, but in a solid way. But the thing about this company that makes it so interesting is we're buying this company at under 7 times earnings, so a PE of under 7. Historically, this company's traded at a PE of between 15 and 20. And that's the reason I like this company, is I believe that what's going to happen is we're buying this company at between 6 and 7 times earnings. And if we hold the company for 2 or 3 years, it'll go to 15 times earnings. Well, if it goes from 6 to 15, that's a 250% increase in the value of the stock. And that's wonderful. In addition to that, we get a dividend. Hopefully the company's managing to raise its earnings over that period of time, and the company's buying back some shares over that time. And we should see a 3x in this company over, say, a 3 to 4 year period of time. I really believe that's what's going to happen with this stock. And that's why I bought it. It's one of these opportunities. It's a cigar butt investment. It's not, purely speaking, a Warren Buffett play, although the company is a bit of a consumer monopoly. You know, obviously Lazyboy is a brand. It's euphemistically the name for any kind of recliner chair that your dad would sit in to watch TV. And so long story short, there's a lot to like about this company. There's very little to dislike about it. I know we're in a recession and the company might get beat up a little bit because theoretically people are going to stop buying chairs for a little while. But household creation is continuing to form. People are continuing to buy houses. People are continuing to need apartments, and they need a place to sit. And as you get more successful, you're going to buy a nicer chair. And Lazyboy is sort of the gold standard. So that's it for Lazyboy. Hopefully you like the stock. Hopefully you buy some, and we can make some money in it together. Thank you very much for your time.